right into today's Global Macro Explainer. We've got a lot of ground to cover, unpacking the overnight action and handing you the exact tactical levels you need across major currencies and Indian equities. So let's dive right in. Okay, if there is one single glaring number hanging over everything today, it's 1986. The Japanese yen literally just slipped to its weakest level since that year. And with expectations of more Fed tightening really juicing the dollar, this massive threat of intervention from Tokyo is basically a dark cloud hovering over all our major setups right now. Zooming out to the overnight global wrap, we're seeing some pretty incredible contrasts across the board. Get this. Indian bond yields just recorded their sharpest monthly drop in 7 years. Meanwhile, over in the Middle East, diplomacy has, at least temporarily, replaced missiles, and that's stabilizing oil shipments. On Wall Street, the Russell 2000 quietly stole the show, posting its strongest first half since way back in 1991. But man, it was a totally different story for commodities. Brent crude steadied after a steep fall, and gold just suffered one of its absolute worst quarters in decades as stronger U.S. data completely dulled its shine. Moving on to the data horizon today, markets are pivoting hard from those overnight headlines directly to the hard numbers. We are tracking critical manufacturing PMIs across Europe, the UK, and the US, alongside Eurozone CPI and US ADP data. Plus, we've got a seriously heavy roster of central bank speakers across the Fed, ECB, and BOE today. So yeah, policymakers are absolutely going to keep us just as busy as the traders. Right, hitting the tactical desk, let's kick things off with the US dollar index, the DXY. The massive catalyst here, that US 10-year yield spiked sharply to 4.45%. And why did it do that? Well, the JOLTS report showed a pretty surprising uptick in labor demand, right ahead of tomorrow's crucial non-farm payrolls. So the dollar caught a really nice bid yesterday, largely riding on the back of that falling in. The crucial takeaway here is our tactical structure for the DXY. It stays firmly as a buy on dips. We're looking at resistance up at 101.41, with some really solid support sitting at 100.89 and 100.25. But seriously, be warned, a massive yen intervention is the primary risk here. When Tokyo steps in, they usually drag other major pairs right along with them. Add Fed Speaker Warsh to the docket today, and you should definitely expect some fireworks around these levels. Shifting gears to Euro USD, German CPI just decelerated month over month as those energy price pressures finally eased up. And this perfectly captures the current mood over at the ECB. I mean, President Christine Lagarde essentially just declared that policy has gone back to basics with, and I quote, measured adjustments to rates. Today, all eyes are locked on the broader Eurozone CPI prints, where consensus is looking for a 20 basis point fall. So, tactically for the euro, we're looking at a classic sell-on-rise setup. The pair pulled back as the dollar gained strength, which leaves our resistance capped at 1.1447 and support down at 1.1388. But again, and I really can't stress this enough, the main risk to this view is spillover from any sudden Bank of Japan intervention. Looking at the pound, the data is actually holding up quite well. The UK economy expanded by an unrevised 0.6%, which marks a second straight quarter of growth, heavily driven by services. But Bank of England Governor Andrew Bailey kind of threw some cold water on things. He noted they are in no rush to respond to energy spikes and admitted that hitting their inflation targets is going to take, his word, frustratingly longer than expected. Because of that, the pair tested our exact resistance at 1.3265 yesterday and then just pulled right back. So that perfectly maintains our sell-on-rise bias. If it does manage to break, the next ceiling is up at 1.3326, with support holding the line at 1.3150. Keep an eye out for the S&P manufacturing PMI print today, but remember, the wildcard risk here is, once again, looking east. And speaking of looking east, let's get back to that historic battered yen. From the lows we saw after that mid-April intervention, the USD/JPY pair has absolutely skyrocketed, up 5.20%, and it hit our primary extension target exactly at 162.71. Just nailed it. On top of that, Japan's Tankan survey just threw up some really great numbers, keeping this trend of surprisingly solid Japanese economic data alive. Right now, the Bank of Japan is kind of just letting its resolve get tested without actually stepping in. The absolute key level you need to watch is that 162.71 mark. If we get a clean break above this, it literally opens the door straight up to our final target of 164.60. Downside support levels are sitting right at 161.94 and 160.55. All right, let's pivot and turn our attention over to India, where the rupee has staged just a massive comeback. After sliding down to a record low near 97 per dollar back in May, it rebounded hard to close at 94.66. It actually emerged as one of the strongest performing regional currencies in June, posting its first quarterly gain since March of last year. This whole reversal was heavily driven by that sharp correction in crude oil prices, plus some very specific policy measures aimed at drawing in dollar inflows. So tactically, our view here remains sell on rise. Yesterday's high was actually capped perfectly right at the 20-week moving average of $94.68. Now, the firmer US dollar is definitely weighing on sentiment a bit today, so we're seeing resistance up at $94.92, with immediate supports below that at $94.51 and $94.06. Finally, closing things out with Indian equities. The market signed off the quarter with a bit of a frown, honestly. The Nifty kept up 90 points yesterday, but then just ran straight into a severe bout of monthly expiry volatility, eventually closing lower at 23,865. The IT sector really took it on the chin, dropping 2.7% on the day, mostly dragged down by fears that higher US inflation is going to keep the Fed tightening. But hey, June was still kind overall. The Nifty gained 1.4% for the month, largely because banking and financial stocks absolutely stole the spotlight and surged over 6%. So even with the turbulence from that bruised IT sector, our tactical approach on the Nifty is still buy on dips. To really get the momentum going again, though, we absolutely need a clear break above the 23,900 resistance. That is the key to unlocking our higher target of 24,344. On the downside, you're looking for solid support right in the 23,767 to 23,8031 zone. And that wraps up our tactical breakdown across the board. But the massive question heading into the open, the one thing that is absolutely going to dictate the flow of the entire market today, is this. Is Tokyo finally going to blink and push that intervention button to save the yen? Or is the dollar's underlying buy-on dips momentum just truly unstoppable at this point? Keep your technical levels tight, watch those data prints closely, and let's see exactly how the market answers.